Have you ever wondered how tax works? The first known system of taxation was in ancient Egypt, around 3000 to 2800 BC, the first dynasty of the Old Kingdom of Egypt. Now, the system of taxation has branched into various segments, benefiting both the people and the government. Different countries have different methods of taxation, but all of them have something similar. That is the concept of flex taxes on essential and daily goods. Now let's have a look on the taxation on goods for a few countries.
First off, we are going to be starting with Japan. In Japan, the primary form of indirect taxation is consumption tax. Introduced in 1989, this tax is similar to VAT and is applied to most goods and services. Currently, the standard consumption tax rate is 10%. This rate applies to most transactions, including sales of goods and services, and is collected at each stage of the supply chain.
There are also certain reduced rates for certain items, 8% on appliances such as specific goods and services such as food, beverages excluding alcohol, and certain newspapers to lessen the tax burden on essential items. Some items exempt from consumption tax, including exports and certain financial and insurance services.
Now we'll talk about Russia. In Russia, the main form of indirect taxation is the value-added tax. It's a tax on the value added at each stage of the supply chain, from production to the final sale of goods and services.
VAT in Russia operates under three key rates. A 20% is the standard rate, applied to most goods and services. 10% is a reduced rate, generally applied to essential goods like food products, children's products, and medicinal supplies. A 0% rate is applied to specific exports and international services, supporting Russia's trade activities by ensuring that VAT does not hinder global competitiveness.
Now we will talk about India. Even India has a GST system. The Goods and Services Tax (GST), introduced in 2017, is a unified system replacing multiple indirect taxes previously levied by both central and state governments. This system simplifies the tax structure by consolidating various taxes into a single framework.
GST is categorized into three types. Central GST. It is collected by the central government on transactions that occur within the state. Secondly, SGST, State GST, collected by the state government on those same intrastate transactions. IGST, Integrated GST, applied to the interstate transactions where the central government collects the tax and later distributes a portion to all the other states. The tax rates under GST vary, typically falling into four slabs: 5%, 12%, 18%, and 28%. Essential goods are taxed at lower rates, while luxury items and non-essential goods are taxed at higher rates. This uniform structure helps create a more efficient market across India, reducing the complexities and fostering a better tax compliance.
Lastly, we have Australia. In Australia, the primary form of indirect taxation is the Goods and Service Tax (GST). Implemented in the 2000s, GST is broad-based on the supply of most goods and services. It operates at a standard rate of 10% and is applicable to the most transactions in the economy. It is collected at each stage of production and distribution chain, from the businesses to the consumers.
Certain items are exempt from GST or are at a lower rate. These include essential goods like fresh food, certain health services, and educational services. This ensures the tax system does not disproportionately affect the basic necessities. Businesses are responsible for collecting GST on their sales and can claim credits on their GST paid on their business purchases, thereby avoiding tax cascading and promoting fair taxation.